What's up guys, welcome back to InvestingPH. Today I'm going to share with you 4 dividend stocks I'm investing in to start off 2025. But before that, I just want to explain, especially to my new viewers, why I'm always showing these datas, ratios, graphs every time I'm showing the stocks I'm buying, why I never tackle about economics, applying those complicated projections to my videos, guessing what a company might do, or saying that this company might be the next big thing, but just rely on these plain basic financials and ratios that I'll show later on. In fact, even my intrinsic value formula does not factor in interest rates, GDP, economic growth, but solely rely on what the company have shown for the past years and projecting that growth, assuming it will grow the same amount for the years ahead as it did in the past. Everything I show are what a company has already proven. To begin my explanation, first off, what I'm showing are just a quick summary or overview of these stocks, and this is actually how I scan for potential investments. If they don't pass this quick checklist, then I move on to the next stock. I don't project, assume, or make a gamble or anything based on the popularity of the stock or what some news or article has shared. Second, why I solely rely on these financial and ratios that you can get on free websites, because let's face it, I am no expert when it comes to investing. I don't have the resources as those analysts working for brokers and banks have. And let's be real, even with their resources, no one can predict what the economy will be doing. Even the stocks I invest in, I don't have control to what the management of the company will be doing. So I rely on what I can control, which are the companies I will be putting in my portfolio. I don't want to overcomplicate things. I want to increase my chance of success by investing in the company instead of historical good financials, and I determine if it's worth buying at the price offered to me. Chances are, if the company has good financial history, more likely, take note, I'm not saying that I'm sure, but most likely, the company have a higher chance to grow the next year. And financials also give us a quick glimpse on the leadership of the company. If the company is doing good, then of course, this shows us the management is responsible and determined to grow the company. This is what I call common sense investing, especially for a dividend investor. Why take the risk of choosing a company that has negative earnings, high debts, diminishing or not even paying dividends? I'm no angel investor. I take my chances to those companies that have a higher chance of growth, and this can be reflected from the financials of the company. I don't need to make my job as an investor complicated by applying all those economic data which all of us don't have any control. Let's leave all of those to the experts. That's why I love my intrinsic value formula, because it makes sense for me. By the way, if you haven't watched my intrinsic value formula video, then there is a link below. What I'm doing is projecting the earnings of the company based on its historical growth compounded average and applying a conservative rate of return and applying a margin of safety as well. Everything I put into the formula, I understand, and it's not based on biases in economics, but the historical performance of the company. So this was a long talk, but this is a glimpse of my investing strategy, which I think is very important to explain. Yes, it's very simple. I also said that to myself 5 years ago, that if this is all there is to it, then why isn't everyone successful? Well, because emotions come into the game. That's what differs from each investor. Even if Warren Buffett lay out his investing strategy and all the stocks he invests in, which he actually does by the way in his Berkshire letters, even with all that, if you can't control your emotions and panic buy or panic sell every time the market fluctuates, then you will fail. And as well, if you don't have the discipline and commitment to compound your money for a long time, then you will fail. It is very simple, but yet when emotions and discipline comes into play, it becomes very hard. That's why I keep it simple and just invest in the companies I'm comfortable holding for a long time, which gives me consistent dividends, and this helps me stay calm because I trust the companies I hold. It is not based on biases or outrageous projections and growth, it is based from the proven performance of the company. Anyway, to start, the first dividend stock is Shang Properties, which has been involved in property investment and development in the Philippines since 1987. It operates through property development, hotel operations, malls, offices, and residential. Now this company was quite familiar to me way back when I was in high school, as I've been to their mall regularly and to some of their hotels like the one in the Fort and to Edzo Shang and Makati Shang as well, which indirectly has a connection to Shang Properties through their parent company, the Kuok Group. So these were my childhood. That's why I started researching this group, whose property arm here in the Philippines is Shang Properties. For their financials, like most in the property sector, it was affected hard during the pandemic, but Shang has recovered well. Their net earnings have reached record highs, and what I really like about this company is they're managing their debts well, and equity has steadily increased over the years, and their debt to equity is only 0.56, which is low, meaning they only have 0.56 pesos of debt for every 1 peso of their equity. As for price valuations, Shang's PE ratio, even with its stock price increasing significantly for the past years, is still one of the lowest at 3.1. This is because earnings of Shang has recovered and have surpassed their pre-pandemic level, catching up to its price, while for their price to book, it's still at 0.4, which is relatively level with its peers. For its dividends, they have consistently increased it over the years. Right now, even though its stock price has increased, its dividend yield still sits at 7.4%. That's why for a dividend investor like me, Shang has caught my attention as its financials, price ratios, and high dividends far exceeds my checklist. They're also continuing their growth. As of now, they have several ongoing projects that gives them a chance to grow their earnings, which eventually grows their dividend payout. For my buy price, it's 3.94 pesos. Though the price during the creation of this video is slightly higher, it sometimes goes below my buy price, which allows me to buy it. This stock is one example for me of investing in what you know, since I've been to a lot of their businesses. Seeing the companies up front is just a good feeling as an investor, and knowing their financials are good gives you more of that sense of security that you're making a good decision. The next one is FGen, a power company. FGen is the largest renewable energy producer in the country, engaged in natural gas, geothermal, hydro, wind, and solar production. As of March 2024, they are producing 3,668.2 megawatts of electricity. Now, I am a big investor in the power sector. I hold AP, FGen, C-REIT, and DMC, which has a share in the energy sector as well. All in all, it accounts for more than 12.4% of my portfolio, which I think is even higher as some of my holding companies hold a power business. For me, the power sector has a good moat since it is a necessity, and when a country grows, so was the demand for their business. Most of the companies I hold are now investing big in renewable energy, and FGen, being the largest supplier of RE, has convinced me to invest big in this company. I was lucky enough that the stock price of the company went down these past few months. The company, although doesn't have as high as dividends as my other stocks, still boasts a 5.2% yield and only has a payout ratio of 11%, meaning its dividend payout is well within what the company earns and still has more left to reinvest back to the company to buy or build more projects in the future. Earnings, though has their ups and downs, have grown for the past 10 years, equity has grown consistently, and their debts have decreased for the past years. Debt to equity is only 0.75. For its price valuation, P is only 3.9, which is very low compared to its peers, and price to book as well, the lowest of them all. So this tells me the company is producing good earnings, managed debts, and the price is trading well below its peers, and equity is growing well, and it's giving a good amount of dividends. Well, for me, it's very undervalued. For my buy price, I've set it as 16.94. The price right now is a bit higher, but with the market going up and down, it has given me a lot of room to buy it for the past months. By the way, if you like the graphs I'm showing, this is from Simply Wall Street. This platform has helped me tremendously in filtering stocks to add to my watch list. The way they present their data is so easy to understand, and they also update me whenever the company releases its earnings, dividends, when insiders are buying or selling, and when the stock falls below its intrinsic value. They also have a portfolio tracker that lets you assess the health of your portfolio. So if you want to try it out, they offer their basic plan forever free, but if you want to have access to all the tools, then use my link below to sign up to their paid plan to get up to 50% discount. The third dividend stock I'm buying is RCR. This has been the newest addition to my REIT investment. Right now, I'm heavily invested in REITs, which takes up the largest share of 17.9% of my portfolio. RCR has grown well these past years. From the research of DragonFi, core net income has grown well in the past years, and on July 16, 2024, RCR infused 13 assets consisting of malls and office buildings. Of those, 11 are mall assets, which increase RCR's gross leasable area by 72% or to 827,807 square meters. This diversifies well their portfolio, and this can grow their earnings and dividends in the future. This is why I've invested a lot during the last 2 months in this company, with REITs giving off 90% of what they earn as dividends. it is important to see that they are infusing more into their portfolio. Right now, PE ratio compared to its peers is low at 7.5, and the price to book as well is trading 1 times its equity. For my buy price, I computed it using the dividend discount model, using a growth of 3% and a margin of safety of 25%, getting a buy price of 6.08. So far, its stock price is well below my buy price. That's why I've been able to invest in it. By the way, before I show you my last dividend buy, as I mentioned, the data I've shown was from DragonFi, which is a broker I use. The research they post is a big help for me, as most of these data are hard to find. Their platform stands out, especially its mobile app, which if you don't know how to compute the buy price of the company, you have there the signature portfolio, which of course shows your very own InvestingPH portfolio. And they automatically show you the stocks in my portfolio that are trading below my buy price. And if you want to see the whole portfolio, you just go into the next panel, which shows all the stocks I own and their respective buy price. Yes, these are updated. Whenever I change something, it is automatically shown here. And there are a lot of tools installed for you in their platform, different portfolios to copy, news updates, and more. So sign up now to DragonFi using my link below, and both of us can get up to 1,500 pesos depending on your initial funding. The last stock for today is PLDT or TEL, my newest addition to my portfolio. If you've been following this channel for years now, I've mentioned this company a lot of times, and it's only last month that I added it to my portfolio. PLDT and Globe are the biggest when it comes to telecommunication. Both have cemented their brand to Filipinos, so I've owned Globe for a long time now, and since PLDT's price has dropped, then this is the best time to add it to my portfolio. TEL's dividend is at 7.4% right now, and they have paid consistently over the past years and have actually increased it. Revenue has grown as well, though their earnings have remained stagnant. This is the reason as well it took me a long time to invest in PLDT, as its financials aren't on the same level as its rival Globe. Debts have increased as well over the years. Equity again remains stagnant. Though telco companies have higher debts compared to other industries, their debt to equity stands at 4.49. So if you compare this, Globe's debt to equity is only 2.71, though still a bit high, but is still lower than TEL. This is because TEL's assets have stagnated and slightly decreased in the past years. If you look at TEL's PE ratio, it's lower compared to its peers at 10.4, but for its price to book, higher as its equity has yet to catch up. So why did I buy TEL even though a lot of its financials aren't a check on my checklist? Well, PLDT has a good brand moat in our country, and as of now, they are still expanding their business, and I don't see this company going extinct for the next 10 years. The positive side is while revenue has gone up over the past years, this may be a good sign that their business is improving, and the company is paying a good amount of dividends for the past years consistently. But knowing all the negatives, I have limited my investment to an amount I'm comfortable putting into this company. I'm not going all out, as I know the risks involved. But again, as I'm waiting for the company to improve its financials, I'm getting a good amount from dividends. So for this company, I put my buy price at 1,397, and I'm only putting an amount I'm comfortable with, as I know the risks involved, so that when the stock price drops, well, it won't make me panic, as long as it doesn't compromise my comfort level. This is very important for me, as I don't want to panic every time the stock price drops. As I said, I want to control what I can control, and this is me controlling that. I'm only putting an amount I'm comfortable with at a price I'm comfortable buying the company as well. With that, this ends this video for today, and I hope you've learned something. So if you did and still haven't clicked the like button, then I'd appreciate it if you do so before leaving. Thank you, and see you in the next video.